Hello, dear friends. Welcome back to this cozy little corner where stories come alive and where every life, no matter the age, carries wisdom worth sharing. Today, meet Walter Thompson, a man who learned the hard way that safe isn't always safe. At 70, he's seen how money can quietly vanish, not from wild spending, but from places that seem secure. Some of the biggest financial mistakes, he says, are the ones we make thinking we're playing it safe. In this video, Walter reveals 7 safe places that are secretly killing your money and how to protect what you've worked so hard for. And if his story touches your heart, leave a number 1 in the comments below as a sign of shared feeling. And don't forget to share this story with the people you love, because maybe, just maybe, it's exactly what they need to hear right now. Walter Thompson sat in his cozy Ohio study, the faint hum of a lawnmower drifting through the open window. At 72, his silver hair caught the afternoon light, and his hands, weathered by decades of work, cradled a worn notebook filled with financial wisdom. A retired advisor, Walter had guided countless American families through the turbulent waters of money management. But his own journey was marked by missteps that still lingered in his memory. Now, in 2025, with the world spinning faster than ever, gas at $4 a gallon, homes priced beyond reach for many, he felt a burning need to share a truth he'd learned the hard way. The safe places people entrust their money to are often silent wealth killers, eroding dreams with a deceptive smile. This is Walter's story, a tapestry of triumphs, regrets, and hard-earned insights. These are the 7 safe places that quietly kill your money, told through the lens of a man who's lived it, with a heartfelt plea to act before it's too late. Number 1. The savings account, a false fortress. Walter's earliest memory of money was his mother handing him a passbook savings account at age 16, her eyes glowing with pride. "This is where you build your future," she said. It was the 1970s, and savings accounts paid 5 to 6% interest, a respectable shield against inflation. Walter faithfully deposited his summer job earnings, watching the balance grow. By his 30s, though, the world had shifted. Interest rates plummeted, and inflation began outpacing his savings. A $1,000 deposit from 1980 could buy a used car back then. By 2000, it barely covered a month's rent. In 2025, the average savings account yields a paltry 0.7%, while inflation hovers at 3.5%. Walter likens it to parking your money in quicksand. Banks advertise safety, but it's a mirage. Your $20,000 emergency fund, left untouched for a decade, could lose half its purchasing power. Walter recalls a client, Linda, who kept $50,000 in a savings account for security. When she needed it for her daughter's college in 2023, it covered only a year's tuition instead of the 4 she'd planned. She was heartbroken, Walter says, his voice catching. She thought she'd done everything right. The trap lies in psychology, Walter explains. Savings accounts feel secure because they're familiar, insured by the FDIC, and free of market swings. But that comfort comes at a cost. Inflation is a thief that never sleeps, and low interest rates are its accomplice. Walter's own mistake was leaving too much in savings for too long, assuming it was safe. He missed years of growth that could have funded a better retirement. Walter's advice: Keep 3 to 6 months' expenses in a high-yield savings account, 4 to 5% APY in 2025 for emergencies. Move excess funds to investments like low-cost index funds, which historically return 7 to 10% annually. Don't let comfort rob your future, he urges. Number 2. The Dream Home Myth. In 1992, Walter and his wife, Ellen, stood in the driveway of their first home, a brick ranch in a Cleveland suburb. They'd stretched their budget to afford it, seduced by the promise that homeownership was the cornerstone of wealth. Real estate never loses value, their realtor insisted. For 15 years, they poured money into mortgage payments, property taxes, and repairs. A new roof in '98, a water heater in '03, endless landscaping. When they sold in 2007, just before the housing crash, they barely recouped their costs after inflation and fees. "We thought we were investing," Walter says, shaking his head. "We were just treading water." Homes are emotional purchases, Walter learned, but they're rarely financial windfalls. In 2025, the average homeowner spends $20,000 annually on maintenance, taxes, and insurance, money that could have grown exponentially in the stock market. Walter shares the story of his client, Maria, who bought a $600,000 home in 2019, convinced it was her path to wealth. By 2024, her home's value had barely budged, but her costs hadn't. Property taxes rose 10%, and a foundation issue cost $15,000 to fix. She was trapped, Walter says. Her money was locked in a house she couldn't afford to keep. The myth persists because of survivorship bias, Walter explains. People hear about the lucky few who bought in booming markets, not the millions who break even or lose. Homes are liabilities, expensive to maintain, illiquid, and vulnerable to market swings. Walter's regret is not buying the house, but overpaying for it and expecting it to make him rich. Walter's advice: buy a home within your means, ideally 2 to 3 times your annual income. Treat it as a lifestyle choice, not an investment. For real estate exposure, consider REITs, which offer diversification without the headaches of ownership. Number 3. The 401k, a fee-filled mirage. Walter's first job in 1978 came with a 401k, and he was ecstatic. The employer match felt like free money, and he dutifully contributed 10% of his paycheck, choosing funds with optimistic names like Dynamic Growth. But in his 50s, he audited his account and felt a chill. Fees, management fees, expense ratios, administrative costs were draining 2.5% annually. Over 30 years, those fees could slash his retirement by 40%. "I was paying for someone else's yacht," he says wryly. In 2025, 401ks remain a cornerstone of retirement, but they're riddled with traps. The average plan charges 1 to 2% in fees, and many workers pick high-cost funds without scrutiny. Walter tells of his friend, Robert, who retired in 2021 with $900,000. Had he chosen low-cost index funds over actively managed ones, he'd have had $1.3 million. Those fees cost him a decade of travel, Walter says, his voice heavy. He deserved better. The problem is opacity, Walter explains. Plans bury fees in fine print, and employees rarely question them, trusting their employer's choices. Walter's mistake was assuming his plan was optimized for his benefit. He didn't ask questions until it was too late. Walter's advice: log into your 401k and check the expense ratios of your funds. Switch to index funds with fees below 0.2%. If your plan's options are poor, roll over to an IRA when you leave the job. Every dollar you save in fees is a dollar working for you, Walter says. Number 4. Cash hoarding. The cost of fear. Walter's uncle, a child of the Great Depression, kept $10,000 in a locked box under his floorboards. "Banks fail, kid," he'd warn. Walter thought it was eccentric until 2008, when Lehman Brothers collapsed, and he felt the ground shake. He started keeping $5,000 in a safe, just in case. But as years passed, he saw the folly. Inflation eroded the cash's value, and it earned nothing. By 2020, his $5,000 bought 20% less than it did in 2008. In 2025, cash is a losing bet. With inflation at 3.5%, $10,000 in a safe loses $350 a year. Worse, it's a missed opportunity. That $10,000 invested in a broad market ETF at 7% annual return could grow to $25,000 in 15 years. Walter shares the story of his neighbor Grace, who kept $75,000 in cash for emergencies. When she needed it for a medical procedure in 2024, it was worth 25% less in real terms. She felt secure, Walter says, but security was an illusion. Fear drives this trap, Walter believes. Cash feels tangible, controllable, but hoarding it is like refusing to plant seeds because you're afraid of a drought. Walter's regret is letting fear dictate his choices for too long. Walter's advice: keep a small cash reserve, $5,000 to $10,000, for emergencies. Invest the rest in safe liquid options like treasury bonds or ETFs. Don't let fear steal your growth, he says. Number 5. Bonds, the outdated safe haven. In the early 2000s, Walter's clients begged for bonds. "They're steady," they'd say, picturing predictable interest payments. Walter bought in, allocating 40% of his portfolio to municipal bonds. But when interest rates spiked in 2022, bond prices plunged. His safe investments lost 12% in a year. "I felt like a fool," he admits. Bonds aren't the bulletproof shields of yesteryear. In 2025, with rates volatile and inflation persistent, long-term bonds are risky. Walter recalls a retiree, Helen, who put 70% of her savings into bonds in 2018, seeking stability. When rates rose, her portfolio shrank, delaying her retirement by 5 years. She trusted the old rules, Walter says, but the game had changed. "The trap is over-reliance," Walter explains. "Bonds have a place, but they're not immune to market forces. Rising rates hurt prices, and low yields struggle against inflation." Walter's mistake was overweighting bonds without understanding their risks. Walter's advice: use short-term bonds or bond ETFs to minimize rate risk. Balance them with equities for growth. Safety isn't about avoiding risk, Walter says. It's about managing it. Number 6. Insurance products. The hidden cost of peace of mind. Walter's biggest financial regret is the whole life insurance policy he bought in 1985. The agent pitched it as a safe way to protect his family and save for retirement. For 25 years, Walter paid $400 a month, only to discover that fees and commissions had devoured his returns. When he cashed out in 2010, he got back $20,000 less than he'd paid in. "I was sold a lie," he says, his jaw tight. Insurance products, whole life, variable annuities, even some long-term care policies are marketed as safe harbors, but their complexity hides steep costs. Walter tells of his client, David, who bought an annuity in 2015, lured by guaranteed returns. When he needed the money in 2023, penalties and fees ate 30% of his principal. He was furious, Walter says. He thought he'd been prudent. The trap is emotional manipulation. Walter believes agents prey on fear of death, poverty, or medical bills, pushing products that sound safe but enrich the insurer. Walter's mistake was trusting the pitch without digging deeper. Walter's advice: buy term life insurance for protection and invest the savings in low-cost funds. If you need long-term care coverage, compare policies carefully. Read the fine print, Walter insists, or it'll cost you. Number 7. Inaction. The silent wealth destroyer. Walter's deepest regret isn't a bad investment. It's the years he did nothing. In his 20s, he hesitated to invest, scared of losing money. He waited for the perfect moment, missing the 1980s bull market and the post-9/11 recovery. By his 40s, he calculated he'd lost $250,000 in potential wealth by staying on the sidelines. "I thought I was being cautious," he says, "but I was throwing money away." In 2025, with markets volatile and headlines warning of crashes, inaction is tempting, but Walter knows it's the costliest trap. "Time is your greatest asset," he says. "Every year you wait, you lose compounding's magic." He shares the story of his niece, Sophie, who started investing $200 a month in her 20s. By 2025, at 34, she had $45,000, thanks to steady contributions and market growth. "She didn't overthink it," Walter says, smiling. "She just acted." The trap is paralysis, Walter explains. People fear mistakes, so they freeze, letting opportunities slip. Walter's regret is not starting sooner, trusting time over timing. Walter's advice: start small, $50 a month in a Roth IRA or ETF. Automate contributions to remove emotion. The market doesn't care about your fears, Walter says. It rewards those who show up. Walter closed his worn leather notebook, its pages heavy with more than numbers. Within it lived a lifetime. Mistakes, lessons, quiet victories, and deep regrets. The room fell silent, as if even the past itself paused to honor the truth he had just shared. At 72, Walter had nothing left to prove. He had weathered the bitter winters of recession, the searing summers of opportunity, and the long nights of wrong turns. He had lost money to things that seemed safe, but turned out to be beautifully disguised traps. Savings accounts quietly eaten away by inflation. The dream home that slowly drained his finances. A 401k bled dry by hidden fees. Cash that grew more worthless each year. Bonds that betrayed him just when he needed stability. Insurance policies sugar-coated with fear. And above all, inaction. The silent destroyer that stole his most precious asset, time. But in those losses, something else was born. Wisdom, forged by fire. And from that wisdom came a purpose he could no longer ignore: to help you avoid the same painful path. Dear friend, Sit with yourself for a moment. Ask honestly, where is your money sleeping? Are you living through fear or with intention? Your money isn't just a number in a bank account. It's the bridge to the future you deserve. Don't let it dissolve into these comforting traps dressed up as safety. Start small, start now. Tonight, log into your retirement account and check the fees eating away at your future. This week, move $1,000 into a high-yield savings account. Give yourself a lifeboat that floats. This month, open an investment account, even if it's just $50 a month. Tiny, consistent steps can build empires. You don't need to be rich. You don't need to be brilliant. You just need one thing: to act. Walter lifted his cold cup of coffee, eyes soft with memories of what he's lived, and bright with hope for what you still can create. To your wealth, true wealth, rooted in clarity. To your freedom, not just financial, but emotional. And to have the courage to act, starting today. The future is still waiting. Go to it. It's not too late, as long as you begin now. Thank you for taking the time to listen and walk alongside us. We hope today's story touched a quiet corner of your heart. Hold on to that feeling. And if you found even a spark of inspiration, we invite you to stay with us for the next stories to come. Each journey we share carries a message, a ray of hope, and perhaps it's exactly what you or someone you love needs right now. We'll see you again in the next story, where together we continue to share, to heal, and to move forward with hearts full of courage and hope.